All right. I think we will start. Hello, everyone. Thank you for joining us for the first of what will be a quarterly series of webinars from Maxwell-Kates on various topics important to the community that we serve. All of you, co-op and condo owners, members, co-op members, residents. Before I introduce myself and my fellow panelists, I wanted to just acknowledge that, obviously this topic is an important one to the community we serve. We're also mindful of people in other communities in other parts of the world in harm's way, and hoping they find safe passage and hopefully lasting peace. My name is Andy Marks. I'm Senior Vice President at Maxwell-Kates, where I oversee all new business and marketing efforts and manage a small handful of buildings as well. I started my career in property casualty insurance and risk management at Chubb on multiple ends of that business. I spent the past 2 decades in media, entertainment, and advertising, including stints at Universal Pictures, PR firm Edelman, and most recently running my own marketing and entertainment consultancy. I spent 7 years serving on the board of my own co-op, a 210-unit building on the Upper East Side of Manhattan, the last 5 as president. So I've sat in the same seat as you have in the last bunch of years. And I enjoyed the experience so much that I decided to make it my career. And I couldn't be more pleased to be at Maxwell-Kates and have never looked back. I am also a New York State licensed real estate salesperson and a graduate of Colgate University. Fellow panelist Max Freedman is CEO of Maxwell-Kates. He joined the company in 2003, rising through the ranks to become CEO in 2019. He has vast experience of all aspects of real estate property management, having grown up in the business, literally and figuratively, learning from his father, Robert Freedman, co-founder of Maxwell-Kates, now retired. Max's hands-on experience ranges from managing capital projects, including facade rehabilitations, roof replacements, elevator modernizations, and sidewalk rehab, to window replacements, heating system upgrades, and more. Aside from his leadership duties as CEO, he also still plays a role in ensuring the firm's compliance with regulatory matters, as well as financial and tax matters, and clean energy building initiatives. He takes great pride in having created the mentorship program at MKI to ensure the growth and development of young talent in the management industry. He holds a PCBR insurance license from POHS Institute, maintains a CPM designation from NYU, and is a New York State licensed real estate broker. And Stan Russo, my other panelist, has a degree in forensic psychology and has authored 3 books in true crime, history, and cinema. He currently consults for private clients, as well as one of New York City's leading tax certiorari firms for over 15 years. Stan is intimately involved with preparing cases for successful appeals. We're going to talk a lot about that in the discussion, and is one of the foremost experts in shepherding clients through the entire tax certiorari process in New York City. Max, I understand, wants to say a few words. Max, I'm going to turn it over to you.
Andy, thank you so much for the introduction, and I'm very pleased and excited to be here tonight representing Maxwell-Kates as we kick off one of the first of many future webinars that we will have on important industry-related topics. And what better way to start than by focusing on real estate taxes, the different tax classes of New York City, important dates to be aware of, how taxes are calculated, and its overall impact on the co-op and condo world which we live in. I'm honored to not only be joined by Andy Marks of Maxwell-Kates, but also Stan Russo, an expert and leader in the oftentimes complex and difficult to navigate field of real estate taxes. So Andy, back to you to kick us off.
Thank you, Max. A bit of housekeeping for you all. I will be acting as host and moderator. We're using the Zoom webinar format, which means you can all see us, but we cannot see you. I will be kicking off with a series of questions to our panelists to get us started, and we'll try to leave about 15 or 20 minutes for questions from the audience at the end. So if you have a question, please use the chat function on Zoom, and we'll try to keep our time to within 1 hour. We know your time is valuable, and we appreciate you again for attending. So let's kick this off. So that we can ground the conversation, Stan, at a high level, can you tell us how the property tax system in New York City works? And more specifically, how it works in relation to valuing co-ops and condos?
Sure. I also want to say thank you for having me. In the months leading up to the start of the new year, the Department of Finance will gather and tabulate the information from rental buildings all across the city, which they are forced to give in their information under what's known as an RPIE. It's a real property income and expense statement. As they gather that information and tabulate it, the Department of Finance's assessors use that information to value all the buildings in New York City. On January 15th or so, a couple days before, one day before, one day after, depending on the date, they will release and publish the assessments for all the buildings in New York City. There is then a 6-week window in order to file your protest to let them know, let the city know that you'll be suing them over the valuation process. How this particularly relates to co-ops and condos is as follows. Co-ops and condos, by statute, must be assessed as if they were rental properties. And that brings me to 2 important factors to value co-ops or condos. Using co-ops as just an example. There is an internal factor and an external factor. The external factor is decided on by the assessors at the Department of Finance. These are called rental comparables. These are randomized rental buildings that an assessor deems comparable and then uses that building's income and expense information to average a number to apply to the co-op or condominium. The internal factor, and this is of paramount importance, the co-op or condo's square footage. And this is the square footage not of a particular unit or of a combination of units. This is outside to outside diagonal gross building square feet. So the city will take that square footage that they have on record and they will say the rental buildings that we deem comparable average, for hypothetical purposes, $40 per square foot of income. They take that $40 per square foot of income and attach that to the square footage of the co-op or condo, come up with an estimated income. They do that for expenses as well, derive a net, divide by a capitalization rate, and that's how you get your market value and your assessed value. What's really important to maintain is to have the accurate square footage of a building. I can tell you over the past 4 or 5 years, I've been involved in over 70 successful cases of having co-op and condo square footages reduced. So if you were to have a building that's being valued at $40 of income per square foot, and that building, the Department of Finance lists at 155,000 square feet, but you have a report that says it's really only 145,000 square feet, you're technically being overvalued based on that error. So it's, again, of utmost paramount importance to make sure that you either hire an architect or get an engineer to come in and measure the building to make sure that the Department of Finance is using the correct numbers to start the process. That's the foundation of the entire property tax system. Rental building information to derive assessments.
So there's the, thank you for that. So the notion of a rental building being comparable to co-ops and condos, can you just dig into that point a little bit?
Sure. The issue here is a lot of people misunderstand what this assessment is or what the tax is. This is not an income tax. This is a property value tax. And as a value tax, it has to be valued as if it was coming from a position of being rented. So because co-ops and condos don't rent their units, even if they do sublet, they own their units, they have to come up with some kind of some kind of underlying principle in order to value them as if they were rentals. So they've devised a system where they take the rental buildings and they deem them comparable and attach their income and expense information. The issue is, what makes a building comparable is so subjective. And there is such a great wealth of metrics that it allows for the foundation of the property tax cert system. That's the basis to argue whether or not value should be reduced. So an assessor will pick subject building A, B, and C for their rental comparables, and a tax cert attorney will pick D, E, and F. Now, D, E, and F should have lower gross income per square foot, and that's the argument, and that's the foundation. So there really is no building that's a rental that's identical to a co-op, but within this paradigm, they have to come as close as possible.
Stan, sticking with you for a minute, much has been made, especially recently with a Bloomberg article on the subject as to why real estate property values and therefore taxes have risen so dramatically during the last decade. What's been driving the increase?
So I've read that article, and I think to understand that article, we need to take a pre-COVID approach to that article and use the teens from 2010 to 2019. In a rental building, and let's use exclusively residential buildings. In a rental building, there are three types of units. There is a controlled unit, a stabilized unit, and a free market unit. Now, technically, value should be derived from an average of all the free market units presented to the entire building. But what the city does is they actually incorporate the stabilized unit and the controlled unit as part of their overall gross income. What happens is when an owner deregulates a unit, comes in, purchases a stabilized unit from the person living there, gives them a buyout, you take a very small rent, say $200, and now you incorporate that into a $5,000 rent. That is a giant increase in gross income. So if you're going to use the entire building's portfolio, the gross income has been going up about 12 to 14% over that 10-year period. And this is where co-ops and condos are valued on. So during the teens, you saw a rise in assessments for co-ops and condos based on that principle. It's called luxury decontrol.
Luxury decontrol. Got it. Sticking with you, Stan. So you talked a lot about the valuation increase and how taxes are calculated. There's something called transitional value.
Yeah. And
I just wondered if you could zero in on that a little bit. I think we have a slide to show. Can everybody see that?
Sure. So approaching this from a gross tax perspective, every single year, a building is going to get a new assessment. Now, we're talking about buildings that are not in a protected tax class, those buildings that have 11 or more units. Those buildings are going to get a new assessment every single year. They don't pay taxes on that assessment. They pay taxes on that assessment plus the prior 4 assessments added together, divided by 5, known as a transitional assessment. Now, if that transitional assessment is lower than their current actual assessment, they pay on that average. So it's that 5-year average times the tax rate to arrive at the gross taxes for the year. So when you have wild increases in taxes, even if you don't have big increases in assessments, what you have to remember is you have an assessment coming in this year, in any given year, that's replacing an assessment from 6 years earlier. So there's definitely going to be a gap in the difference between the current assessment and an assessment from 6 years ago. From a mathematical perspective, you could quickly figure it out by saying the current assessment minus the assessment from 6 years ago divided by 5 times the tax rate is your gross tax increase.
Great. Max, can you provide a specific example? I think this will look familiar to our audience, this next slide. Everybody gets a tax bill.
Sure. Thanks, Andy. So here is an example of a July 1, 2021-22 property tax bill from one of our managed co-ops. This property has around 130 units. These bills for co-ops are mailed to us, the management company. Individual shareholders do not receive this bill. So, Andy, if you can go to the second page of that PDF where it says annual property tax detail, great. That would be a good place to start. So under tax rate, we have this line that says estimated market value. So what is market value? Market value is assigned by the Department of Finance based on the property's income producing potential. And to determine this market value, they compare the property to similar rental buildings using estimated income and expenses that are similar to this one in size, meaning gross square foot, location, number of units, and age. Cap rates are then applied to the building's estimated net income to arrive at this $30 million figure here. Now for co-ops, market value is assigned for the entire building. For condos, the Department of Finance first determines a market value for the entire building, and then for each respective unit. And in a condo, each owner receives his or her own respective tax bill. Now, if you look at the next line, which is the billable assessed value. Now, first, to determine the assessed value, the Department of Finance multiplies the property's market value, which we just spoke about, in this case, $30,151,000 by 45% to arrive at what it's called as the level of assessment or actual assessed value. Now, going back to what Stan had mentioned earlier about phasing in changes over a 5-year period to the assessed value, this results in what's called the transitional assessed value. Now, the Department of Finance uses the transitional assessed value to calculate your property tax bill, but only if this value is lower than your actual assessed value. And in this case, as this is the first tax bill for the 21-22 tax year, and because the Department of Finance reduced the assessed values as a result of COVID of many properties when the assessments were released in January of 2021, the actual assessed value was lower than the transitional assessed value. So that was used as the billable assessed value. And below this are the exemptions offered by the Department of Finance that are eligible to shareholders and owners who can apply for them directly. In this case, SCRI and veteran exemptions, which is deducted from your assessed value. And these exemptions get credited to shareholders by management in the following calendar year. Now you arrive at your taxable value, which is your actual or transitional assessed value, whichever is lower. This is the amount which you are taxed, which for this property is $13,395,002. And then the Department of Finance calculates the amount you owe by the city's tax rate. And this is considered the building's gross taxes. And if a building receives any co-op condo abatement or star credits, they are then subtracted from this amount of your taxes to determine your final net tax bill, which here would be $1.409 million. These abatements are also credited to those eligible shareholders in the subsequent calendar year. And one important thing to note is that property tax bills are mailed quarterly to buildings, i.e. co-ops, or homes, i.e. condos, with an assessed value of $250,000 or less, and semi-annually with an assessment at more than $250,000.
That's great. Thank you for that.
If I can just add the COVID issue. In my 15 plus years, I've never seen an entire city's assessments go down year over year. Now, because of the pandemic and the influx of federal money to the city, they were able to give the taxpayers that break 1 year earlier. So a lot of people are upset that assessments rose again this year. Right. The reason for that is they did not get the federal money again, and they claim it's back to business as usual. But last year, when there was a huge decrease in across the board, the city assessments, that is a result of the federal money given to New York City, which they passed on as a result of the pandemic.
That's a great additional point. So Max, a lot happens in the beginning of the year. You guys talked about that, but there's also a lot that happens later in the year. And this relates to budgeting, right? What are some ways we can help our, co-op and condo board clients get a handle on how property taxes impact the budgeting process? For example, many of our clients are on a calendar year budget. So how do you plan for changes that may come from the tax protest process, which begins earlier in the year, but the actual decision by the city is made later in the year? So how do you reconcile those things from a budgeting planning perspective?
That's a great question, Andy, and something that we prepare for when going through the budgeting process with our clients. For the majority of our co-op buildings that have calendar year budgets, our financial analysts project the increase in the future assessed value for the next tax year, fully recognizing that these calendar year budgets will have been approved a few months before the tentative assessment rolls are released, which is on the January date that Stan had previously discussed. So when the new assessed values are released, our analysts will then go back to the previously approved budget, analyze the delta between what was projected and the actual assessment, and determine whether or not there will be an issue of cash flow, and specifically for how taxes are escrowed monthly in meeting its already approved calendar year operating expenses. Now, our budgeting process here at Maxwell-Kates includes a separate tab showing a chart of its real estate taxes, the difference between the actual and transitional assessed values year over year, and also identifying which years were successfully reduced, if any. This detailed reporting and analysis goes back several years, and we find this tool helpful in not only showing year over year increases, but also how increases in real estate taxes have kept up with increases in maintenance. And it's no surprise that in most cases, on average, the real estate taxes of a co-op represent approximately 50% of the overall maintenance expense. And here is a graph that we created for a prospective client that joined the MKI family in 2021, using Department of Finance data and our proprietary software, and has been recently updated to show the 2022-23 tax year assessments. Now, as you can see by looking at the top right chart, calendar year real estate taxes, the orange bar, since 2018, hover around 60% of the annual maintenance. And while maintenance in this particular co-op is increased by approximately 3 to 5% annually, that's the blue bar, this property's real estate taxes increase about 10% over a 5-year period. And that includes a year with one settlement. So if this building had left maintenance unchanged since 2018, real estate taxes would have increased to approximately 67% of maintenance. Now, for large buildings that also have staff with salaries and wages, rising insurance premiums and utility costs, and not to mention debt service and regular operating repairs and maintenance, all of which for the most part are fixed costs, one can easily see how this budgeting process becomes an integral part of our management focus. It also helps to show assessed value per square foot year over year, as Stan also mentioned, the third graph on this chart, and how it compares to other like buildings, since this is a great tool that tax certiorari firms use when protesting these values.
So Stan, what is the certiorari process exactly? What it's protesting the values, but how does it work? We've touched on some points already, but
Sure.
It's still a bit of a mystery.
Speaking back a step, a little bit about budgeting, projections are always the third rail. We really just don't know where that's going to get to. So it's usually imperative to use about a 5 to 6% increase for protection. And it depends on how conservative you need to be with that protection, your surplus in your in a cooperative's operating account. But it is important when the new assessments come out to go back and look at the delta, like Max says, and see if you need to make an auto correction. So for tax cert, what has to be understood is these are technically lawsuits. The entire purpose of this is to settle cases with the city to get lowered values. How a tax certiorari attorney does that is they'll go into a hearing after all the paperwork is filed and after a hearing are requested. They'll go into a hearing with a tax commission hearing officer. They'll present arguments of alternate rental buildings with lower income and say, these are the buildings that we feel are more comparable, and come up with a lower estimated income, a reasonable expense ratio, and ask for a request an offer of reduction. So that brings into the philosophy of the subjectivity of what makes a rental comparable. And really, it's a perspective that no one has a perfect answer to. If there are 20 hearing officers at the tax commission, some people feel this, some people feel that. It's really about maneuvering your client's numbers in the perfect way to try and move the other person on the other side of the table and try and settle matters.
And that's a member of the City Department of Finance. Who are we?
That's a separate. That's a separate jury. So you're suing actually the City of New York and the Tax Commission, but the Tax Commission is a separate jurisdictional body created solely to hear these arguments. So every year they hear, I want to say 50, 60,000 cases, or at least there are 60,000 applications filed, and they hear a percentage of those applications, 70, 75%. So hearings take place from the beginning of April till possibly as late as December, and arguments are made for tax certiorari attorneys' clients. The process is essentially to get them to move the needle from where the original assessor at the Department of Finance set that bar.
Got it. So how do you know whether the reduction in taxes that the attorney for the co-op or condo might be presenting is good or not, or whether they should accept it, because that has implications, right? What do you look for in terms of that decision?
So generally, the tax cert attorney, upon receiving an offer, will create a memo or a letter detailing their opinions on it. But for my clients, I present a secondary objective opinion on that offer. So what I do is I look at that offer and I compare it to any open years that are currently have not been settled, determine if they have value still, look at the current offer on the table and whether or not it's better to reject that offer because of the older years, reject that offer because it's just not enough of a solid offer, or to accept that offer. The mindset always is to settle cases, but you don't want to oversettle cases. You want to make the right decisions. When you settle a case too high with the tax commission, they have a memory. The Department of Finance really doesn't look at what the tax commission does. They say they do, but they'll come up with their own individual assessments based on their paradigm, which is the RPIEs. The tax commission, however, will look. So if you settle a case at 21 million and then the next year you ask for 19 million, they're going to remember that and they're not going to give that to you unless there are catastrophic events, which you would have to present.
Well, speaking of catastrophic events, one of the buildings I manage happened to have had to be evacuated back in October for structural deficiencies that the Department of Buildings identified. And so, one of the things they're we're all trying to grapple with is what Max recently had another catastrophic event at one of his buildings. What can be done? If my community, it's 26 owners of condos are out and they haven't lived there for about now 5 months. How do you present that to the tax authorities?
So it's important to understand that this foundation, it's not an income tax, it's a value tax. And the value of an empty space still has value. It's not valueless. So in a situation where, as you brought up, the unit owners are not living in the building, the certiorari attorney would hopefully present that argument as a secondary bolstering argument to the hearing officer to say, we understand that you have to charge tax to the building. You're not getting a zero tax bill, even if you don't live there. But they may add a vacancy factor, because at the heart of it, they have to treat them like they're a rental building. They could also ask for secondary tax relief and call on a humane plea. That happened a lot. I had a building that I worked on that had a fire, and everybody was evacuated. And we really hit home the fact that the assessment should be reduced for temporary tax relief. So there are a number of different strategies, but again, at the heart of it, an unoccupied building is not valueless. It still has a value on the open market, even if the unit owners are not occupying it currently.
Yeah, I think also to add to Stan's point, I think it's important to bear in mind that cooperatives and condominiums do not exist for New York City real estate tax purposes. They are valued as if it were a rental building operated by a profit maximizing landlord. So the operations of a cooperative condominium, for the most part, are somewhat immaterial for real estate tax purposes.
Yeah, I get that question all the time. My maintenance is too high, and I have to explain to board members and unit owners that maintenance is, I call it a ghost figure. It's really, maintenance is there to fund the operations of a building. It's not really a rent. If I were to drop a suitcase full of $10 million at a building, they would have no maintenance for an entire year. It doesn't mean that they have no value. So there has to be a clear delineation between operational costs, such as expenses or income for operations, versus value-based rent.
Thanks for that. I'm going to ask one more question related to this, and then we are going to open it up for questions. So I see a couple of you have some questions already, which is great. We'll begin answering them after this next. One thing that has really been steadily increasing for the last several years are the just immense increase in recent years of local laws, passed by the city that are enforced by the Department of Buildings. For example, Local Law 97, which relates to carbon reduction and energy efficiency. Everybody is familiar with the letter grade placards that you have to display in your front window. This resulted in the need for, planning large capital expenditures, whether it's retro commissioning of building energy systems or doing extensive local law facade rehab, Local Law 11 facade rehabs, which my own building where I was on the board had to go through for several years. And that, they have to comply and, avoid those stiff fines that come with non-compliance. And so, Stan, to what extent can such capital improvement projects be used to enter into the reduction of taxes?
So tax cert is very protocol driven. In order to get a tax cert reduction, you present the rental comparables and their gross income, their either expenses or an expense ratio. Now, if a building has 62% expense ratio, that has to be reduced. Using Manhattan as a guideline, I think the limit is about 35%, depending on the area. But with capital improvements, the hope is that you have a tax certiorari attorney who is using those to kind of push the needle above that max expense ratio. So what I would do is I would get the depreciation schedule of a co-op, and I know the firm that I consult for does this. We take the last 15 years worth of capital improvements, add them together and divide by 15, and we come up with essentially a yearly depreciation amount. We use our income, we use our expenses, and then we use that other expense to kind of push the needle a little bit. And we call that a bolstering argument. Now that bolstering argument, 2-3% on a net, can take a building into what could be conceived an offer or make a make a small offer much better. Sometimes no offers turn into offers. Sometimes hearing officers don't buy that bolstering argument. But you want to go into the hearing on the hopes that all the strategies you employ are going to be welcomed, and using the capital improvements and depreciation schedule is just an added strategy to move the needle.
Max, anything to add to that?
I agree with everything Stan said.
I agree with what Max said.
Well, that was easy. Well, we have some questions. Thank you, everybody, for submitting. We're gonna turn now to those questions, and the first one comes from Sue Hilty. Do we, as shareholders, have to apply for these abatements yearly, i.e., STAR?
Sure, I'll take that. Sorry, one second, my screen. So if you are currently receiving the basic or the enhanced STAR exemption, you will continue to receive it, but you can choose to register for a STAR credit to receive a check instead of a credit on your maintenance. And the abatement is something, the co-op condo abatement is something that we as a management company apply for on behalf of eligible shareholders and owners.
Okay, great. I'm going to now turn to the Q&A. Looks like folks are using the Q&A, which is great. Will you be addressing buildings that are in HPD median income programs that will be ending in the next few years and losing their tax abatements?
I'm sorry, what was the question, Andy? Sorry.
Well, it relates to buildings that are in HPD, median income programs, that will be ending in the next few years and losing their tax abatements.
Okay, so that's kind of a nuanced question. So if I understand it correctly, the building that you're referring to is currently receiving either a J51 or a 421A tax exemption. That doesn't mean that your building should not be protesting the assessed values every year using a tax certiorari attorney. So that's one part. The second part is with respect to the elimination of the J51 or the 421A, depending on the timing of that expiration, our Maxwell-Kates will submit what's called an initial application to the Department of Finance to apply for the co-op abatement on behalf of all eligible owners or shareholders. So I hope I was able to answer your question.
If I can just piggyback to that, I agree with that. But there's a delineation between assessment, which is a value proposition, and taxes, which is a net proposition. And what we're talking about here is a building that has an exemption that pays very little in tax, but that program is going to run out. But the assessment is still the assessment. And like Max said, you should have a tax certiorari attorney. You should have an objective secondary look at it from a specialist. You should have somebody tracking to make sure that you're not being overvalued from that perspective. If you're overvalued from that perspective, the exemption's eventually going to run out, but it's going to be harder to sell your units if you're so overvalued. So keeping your value low, even during those times, is very important.
Okay, that's great. So that was Heather Swanson. Thank you, Heather, for that. Now going to George Karras. Why are co-ops and condos taxes assessed differently than single family homes, which taxes per square foot is drastically lower than a condo?
So I guess I'll try to answer this question. It's a very difficult question, but the city of New York has instituted the co-op and condo abatement program to try to level that playing field. And they understand that there are homes that get these huge breaks from the way they have their equalization rate set and the statutory restrictions on a home. In a home, they're in tax class 1, and tax class 1 has a restriction that it can't be assessed greater than 6% in any given year and no greater than 20% over a 5-year period. Now that tax rate is also 22%, 22%, while the residential tax rate is 12.2%. But homeowners generally wind up paying less in tax than co-op owners in New York City. So that co-op abatement program, which is handled by management, is sort of trying to level that playing field.
Okay, great. Another question from Lydia Butler. Our building currently has a 421A tax abatement. We are all extremely concerned that with the expiration of this abatement, it will increase our maintenance by hundreds of dollars a month, depending on the numbers of shares each unit has. Is Maxwell-Kates investigating any programs or options that will enable us to stay in our homes?
I can answer that. So it's a good segue, I guess, into what Stan was describing earlier and what I had mentioned to Ms. Swanson's email, her question. So when the 421A abatement expires, the year before it expires, what we do is we prepare an initial application to the Department of Finance for eligible shareholders or owners to receive the co-op condo abatement. Now, the co-op condo abatement is something that is offered to shareholders that are primary residents. And for the most of the Class 2 tax properties, this abatement represents approximately 17.5% of a credit off of your real estate taxes. So what we do at Maxwell-Kates, our abatement department, for your property, Ms. Butler, would submit a form to all owners or shareholders, whether or not you're in a co-op or condo, that you would then send back to us with pertinent information, not only the unit number, but the share number, the share amount for each shareholder, required information such as social security numbers, EIN numbers, sales date, room count, square footage. It's an in-depth process, and all of this has to be submitted to the Department of Finance for their review and approval. And then this, once it gets approved, will get approved on the subsequent tax year. So for example, we as a management company have a deadline to apply for co-op condo abatements by February 15th of every year. And we do this on behalf of our owners and shareholders for the upcoming tax year. So we recently provided the renewals for the 22-23 tax year. So those are really the other a program that it could be offered to your folks in your development. And there are also other exemptions as well that we kind of touched on earlier, which is a star credit, a senior citizens exemption, a veterans exemption. There's an enhanced star credit, which has certain income eligibility requirements. So we're happy to share some of that information with you.
And if I can, to add to that, the delineation to understand is important. There's gross, there's net, and then there's net. And if you don't handle gross, your net's going to be higher. So it's great to have the extra programs, veterans, star, but those are after the gross happens. So getting that gross as low as possible and those values reduced is of paramount importance.
So Lydia had a follow-up to that, which is, and that would reduce it by 17%. That doesn't make me feel that much better.
No.
Frowny face.
Yeah, knowing how high real estate taxes are, it's difficult to swallow. But yes, the abatement would reduce the gross taxes by 17%, roughly 17%. And again, there are also other exemptions that that you could be eligible for as well.
and I'm unfamiliar with the property, but it'd be interesting to show this person that if there was no 421A abatement, they'd be paying those taxes already. So enjoying this exemption and abatement by the city is a bonus, and at some point it does have to dissipate. So the preparation for that, management most likely is going to handle, but absence of that exemption, the value proposition would still remain and those taxes would be due.
Okay, does anybody else have a question for our panelists? Okay. Well, it's about just under 10 to 7 to the hour. So if our panelists have nothing else to leave you with, I will leave you with this, which is thank you. Thank you for spending your valuable time with us. We hope you found the information useful. I'm just going to place a link in the chat box so that you have it. And this is something that you can go on to the Department of NYC.gov. The Department of Finance has all kinds of resources for the co-ops and condo boards that are dealing with this information, or any resident that has these questions. So I encourage you to go there. Also, you can go to Maxwell-Kates.com and check out our newly launched website. And on there are some resources that we've placed there so that you have more information. And certainly we're here if you have some additional questions.
Andy, the assumption is that there'll be more questions coming in once people see it. You can feel free to share my information with them. I'm more than happy to answer questions. Again, I'm a secondary objective outsider, an expert in the field, and can give a more philosophical approach to this mathematical problem, because a lot of it is it boils down to philosophy.
Sure. So just for everybody's benefit, I'll type it in here. And it's srusso@maxwellkates.com. And you can certainly get in touch with me. My email address is on the website. And again, thank you very much for spending your time with us. And we'll give you back your 10 minutes.
Thank you, Stan.
Have a great night, everybody.
Thank you, Andy.
Thank you, guys.
Thank you, Stan and Max.
Thank you.
Thank you.
Take care of everybody.